Welcome, everyone, to Women on Wealth. I am joined today by Julie Gillespie, who is a CPA with Simione, Macca, and Larrow in Connecticut. Julie, welcome.
Thank you. Thank you for having me.
Now, I know people don't get really excited about the conversation around taxes. However, I asked her to join today for two reasons. Number one, I seem to hear all the time from not only clients, but just individuals in general that we're paying more in taxes. Why is my tax bill getting higher and higher every year? Julie, I'm sure you're hearing the same thing.
Oh, yeah. Yeah.
And I'm going to start on a negative tone is if you look historically at our tax rate in the United States going all the way back to the 1920s, we are actually not at our highest level of taxes. So the potential for taxes to go higher from here, especially when you look at the debt and the conversation that we're having around our US debt, it's possible. So taxes could go higher. And then number two is the tax code is constantly changing, right? And
that's right.
Yeah. So you know better
I will
than
attest to that.
Yeah. So we wanted to have this conversation. And the idea today is to really talk about 8 ways to create more tax efficiency in your investments, in your tax profile, et cetera. So Julie, before we get into that, can you just share with the audience, who you are and how you became an accountant? Because I know when you first became an accountant, there were not a lot of women.
That's right. There were not.
Yeah.
When I first got into the industry, there were very few women. Now, I want to say it's many, many more women.
Good.
Maybe half and half. I'm not really sure the actual statistic, but yeah. There's many more. Yeah.
So how did you embark on this journey?
Yeah, so I chose accounting in college because I took a bookkeeping class in high school and I really loved it.
Wow.
And then I also took a business class called DECA, and it focused on business management, entrepreneurship, marketing, and those types of financial literacy. And I knew that I wanted to do something with business, and I excelled in it. So there you go. I went to University of Connecticut, majored in accounting, received my CPA certificate, my license, and I began working as an intern actually in, well, I won't say how long ago, but it was quite a long time ago. But I've actually stayed with the same firm through several iterations, mergers, acquisitions, and name changes. But it's been 35 plus years. So quite a long time.
That's a testament to the strength of the firm. So congratulations.
Thank you.
Yep. And I'm also so intrigued that you found this passion back in high school. I'm always so intrigued when women tell me about their careers starting at such a young age, since my daughter's about to enter high school. So let's go to the list of 8 rather that I have about how to be more effective in taxes. And just really quickly, we're going to talk about deductions, credits, how to defer taxes, asset location, tax loss harvesting. We're going to talk about different types of buckets that you can look at to invest in. I put parentheses around that if you're listening. And then finally, we'll talk about some tax exempt investments. And Julie and I spoke about this. We want to keep this very broad. We realize this is a very dense conversation, and we're going to mention this again at the end, but we're always welcome. We're always welcome to questions if you need to go deeper into any of these areas. Is that fair to say, Julie?
That is very fair to say.
So let's first dive into deductions. And I'm pretty sure anyone that files their own taxes is familiar with some of these, but I think it's important to be up to date on how these work. And so if you can walk through that, that'd be great.
Sure. So each year on your tax return, you can take the larger of the standard deduction, which is a set amount, and it's based on your filing status and your age, or you can take the itemized deduction if that's larger. So there's several components of itemized deductions. I'll just cover a high level, just a few.
Sure.
So the first I'll talk about is qualified medical expenses that exceed 7.5% of your adjusted gross income, but that's not a very common deduction because most people don't have that much medical.
Sure.
The state and local income tax is the next item.
Mhm.
And that would be, state income tax, real estate taxes, personal property taxes. They're
That's a big
now
one.
limiting that to $10,000.
Yes, and
So
that was a big change a handful of years ago, correct?
that's correct. And since then, a lot of people have just been able to take the standard deduction because they can no longer itemize, since their itemized deductions aren't more than the standard.
Right.
So
And I
the
know there's
next
a
one,
lot of conversation about that changing going forward, but needless to say, right now it's limited to 10,000.
that's correct. Yeah. And the next item is mortgage interest.
Mm-hmm.
And that deduction changed a little bit in 2017 with the Tax Cuts and Jobs Act. It changed mortgage limitation, mortgage balance. After 12/15/17, it's limited to $750,000. It used to be $1 million, but some of those mortgages prior to that time are grandfathered, so you can still use the $1 million balance. So the mortgage interest can be a big number.
And we live in a very expensive
We
state.
do. We do.
Very expensive homes. And Julie, I get this question a lot, but what if you own a second home? What's the impact there?
Yeah, so you can take a first home and a second home, but you have to look at the mortgage balance, right? So you have to do a calculation to see, how much the mortgage balances are,
Right.
and if it's limited
Okay.
based on the balances.
Okay. Nope, that's great. That's great. So you mentioned this, but I think it's important because of some of these changes in the tax law. More recently, there are more individuals that are using the standard deduction that had possibly used the itemized in the past.
Correct.
Yeah. But
Yeah.
I think it's important to know these considerations when you're filing.
That's correct. And a lot of my clients, they seem upset if they can't itemize. And I say, it's really a gift, because if you ever get audited, there's nothing to show. You are entitled to that standard deduction.
Yeah, that's a great point. Well, thank you for that. So the second one are the credits, which are different than deductions.
Yes, the credits are dollar for dollar tax credit. I'll say it's calculated, or it's deducted off your tax. So you calculate your tax and then you deduct your credit. So you're getting a dollar for dollar benefit.
Right.
Whereas deductions, you're reducing your income. So you're only benefiting by the amount of whatever your tax rate is.
Correct.
So definitely credits are better than deductions, but they're both good.
Yeah.
They're both helpful to have. Yeah,
yes,
for sure.
And the credits have changed too.
Yes. So there's a lot of credits actually, and I couldn't possibly talk about all of them today, but you have the child tax credit, the dependent care credit, the education credits, the clean vehicle credit, the residential energy credit, and it goes on and on and on. Foreign tax credit.
Yeah.
So there's a lot.
There's a lot there. And I think I'll stop here and say, I think this is an important topic where if someone is working with you that knows your situation, your family situation, they can help align the credits in the proper way that you should be thinking about it.
Yes, that's exactly what I was going to say as well, and recommend that you talk to your financial advisor and your CPA, because these things are ever changing. Mm-hmm. And, what we talk about today could be different tomorrow, for example. So, and everybody's situation is different, right?
Yes.
So,
yeah. And thank you for saying that the situation can change tomorrow. My compliance officer will be very happy to hear that we address that at the front of the podcast. So, okay, so we have the deductions and the credits when we're filing our taxes. What about deferring taxes with our retirement contributions?
Yeah, so if you have a retirement plan, I like to say pay yourself first, right?
Yes.
And I also like to say set it and forget it, meaning set it up through a payroll deduction if at all possible. Mm-hmm. Pay yourself first, and you won't even have to think about it. You're just saving for tomorrow, and it's automatic. Some common examples of saving are 401k plans, 403b, 457, traditional deductible IRAs, and simple 401ks. Now, keep in mind, there's limits on all of these, mm-hmm. How much you can contribute, as well as income limits for the IRAs. And if you're 50 or over, you actually get an additional, they call it a catch-up contribution. So for example, a 401k, you can contribute 22.5 today,
Yes.
plus a $7,500 catch-up. That's $30,000 that you can put away
Yes.
for tomorrow.
Yeah.
And a traditional IRA is 6,500 plus 1,000 catch-up, so it's 7,500.
Great. And there are so many visuals in our industry that try to help individuals understand that if you put money into a retirement plan like an IRA or a 401k versus just putting money in the same investment in a taxable account, how much more money you can grow over time because it's growing tax deferred, right? You're not paying money on those taxes each and every year. And it's more of a snowball. It's a larger snowball effect than had it been in a taxable account.
Right. It accumulates much quicker because you're not depleting it with the taxes.
Yes. Yeah. And I love the fact that you said pay yourself first, because, you know, you and I have addressed this, but we know a lot of women entrepreneurs, business owners that are so heavily focused on their business that they sometimes forget to take care of themselves.
Mm-hmm.
And the retirement piece is a big part of it. So
yeah,
that's a good one. Thank you. So we talked about deferring taxes. One that doesn't come up as often, but I think it's incredibly important is asset location. And what I mean by that is, as investors, we talk a lot about asset allocation, right? Asset allocation is what you own in stocks and bonds, in cash, international. But this is talking about the buckets. So I just mentioned when we were talking about deferring taxes, we were talking about a retirement accounts versus taxable accounts. That's what asset location is. Can you talk a little bit about that effect of the taxable versus tax deferred?
Yes. So the asset location is basically three buckets, as you mentioned. And I came up with a little terminology that helps me remember. It's tax me now, tax me later, or tax me never.
Yeah. Yes.
The taxable is you're paying tax now. It's your brokerage account, it's your checking account, it's your savings account. The tax deferred or pay tax later is going to be your retirement accounts, your 401k, your traditional IRA.
Mm-hmm.
The tax exempt category, which is not taxable.
Yeah.
Maybe, and I say maybe because you have to meet certain requirements and rules, but it may be a Roth IRA or a Roth 401k and certain tax exempt investments. I think the overall goal is to use more tax efficient investments in a taxable account and less tax efficient investments in your tax deferred account.
Absolutely. Yeah. And maybe an example I can give on that is if you have an investment that is paying out a lot of capital gains and dividends, right? You may prefer to have that in your retirement account, right, where you're not paying those taxes, and maybe have a different type of investment that tends to be a little bit more efficient. And sometimes people will generalize that, talking about mutual funds versus ETFs, which stand for exchange traded funds that tend to be a little bit more efficient and not pay out as many capital gains. But I think that having a thoughtfulness around what investments are going into these different buckets is something that can be incredibly powerful over the long term in investing. Okay.
Good point.
Thank you for saying that. And this falls in line, but I'm gonna segue and talk about these different buckets. There are buckets that have been created now over time that can be efficient when we're talking specifically to education and gifting and medical. Can you quickly address those?
Yeah, so you have the 529 plan,
Mm-hmm.
which is tax deferred growth for the contributions, both federal and state. And there's no tax paid on the growth of the account when the withdrawals are used for qualified purchases. So, and some states have a state tax deduction.
Yes, correct. Yeah,
Okay.
Which is fantastic, including our own in Connecticut.
Connecticut. Yeah. An HSA is another vehicle that you can use. Contributions are tax deductible, and they're pre-tax if they're made through a payroll deduction, mm-hmm, which lowers your overall taxable income. and the interest grows tax-free and withdrawals are tax-free if they're used for eligible medical expenses. So there's rules that you have to meet
Sure.
on these things. Yeah.
I
Yeah.
think most of us are going to have to pay medical expenses at some point in our life.
I think so.
So it's like the 529. You can put money in and you can invest it and let it grow. And then when you take it out for medical purposes, you don't have to pay taxes. So I think, Julie, correct me if I'm wrong, the 520, sorry, not the 529, the HSA is the only triple tax-free bucket that I'm aware of, where, to your point, if you take it out from your payroll, it's tax deducted, it grows tax deferred, and then no taxes on the way out. So
that's correct. I'm not sure if it's the only vehicle, but yes, what you're saying. Yeah.
It's pretty darn close then.
I would think so. There's not many things that are that good.
I mean, if you're not going to get taxed on it, yeah, and you can let it. I think these are examples of some incredibly powerful ways that you can utilize your assets. And the HSA isn't always thought of that way. People think of it almost like an extended FSA, where you it's like use it or lose it, and that's not the case with an HSA.
Right.
So, and then the last one was the on the charitable side is the donor advised fund, correct?
Yes, yes. So donations made to a donor advised fund are eligible for a tax deduction. And it's similar to giving to a public charity, but you can give cash. You can also give long-term appreciated securities, and you get a deduction at the full fair market value of the security, which is a big benefit, because if you have an appreciated stock and you don't need the money and you want to give to charity, it's a good way to do it, because you're getting a good deduction as long as you can itemize, right?
Right.
As long as you can itemize your deductions and you're not using the standard.
That's a good point. Thank you. But I do love the fact that, maybe instead of writing just a check, if you have that appreciated stock, mutual fund, whatever it is, that you don't want to pay taxes on, why not donate that, and you don't never have to pay the taxes, and you get to give to your charity of choice. So
right.
Or you can put it in the donor advised fund, and just like the HSA and the 529, you don't have to donate it right away. You can allow it to grow and then hopefully donate more later over time. So
this is true. Yes.
Yeah. So thank you. So yeah, I think there's some interesting, I like to use the word buckets and ways that you can be a little bit more efficient outside of just the retirement accounts. So those are important considerations. And then speaking of more the retirees, and I know that this has changed, another law that's changed recently. Can you talk about required minimum distributions? This is important for anyone that has an IRA.
Yeah. So we have quite a few clients who use this technique because it is so good. So I want to make sure everybody knows about it. It's the qualified charitable distribution. And if you are required to take a minimum distribution from your IRA and you don't need that money and you're going to donate to charity anyways, you might as well do it through a qualified charitable distribution, because you don't have to pay tax on that money. So the IRA money you get, actually, you don't get it. It goes directly to the charity and you don't have to pay tax on it.
Yes.
You don't also get a deduction on your Schedule A itemized deductions, but you're not paying tax on the money, which is even better.
Yes.
That's even better. But I always like to say, check with your financial advisor, check with your CPA regarding these qualified charitable distributions to make sure it's a good fit for you. There's limits.
Yes.
And, everybody has different situations. So you have to see if it works for you.
Yeah, no, it's a great point. Just had a conversation this morning with a client who was planning for her required distributions for this year. She had 3 places that she wanted to donate to. So we're taking care of it as we speak. So I think this is, for anyone that's charitably inclined, I think this is near and dear to their heart. So
yeah, it's a very, very good tool to use.
Yeah, that's great. Thank you. And then the last one really quickly is probably falls more on the financial advisor, but kind of going back to the taxable accounts, right? Not your retirement accounts, but again, every investment is going to tax you in a different way. And so there are some investments that allow you to receive income tax free. So I'm thinking of municipal bonds, where if you buy municipal bonds, your interest is tax free on a federal level and possibly on a state and local level, depending on where you reside, correct?
Yes.
Yeah.
Yes. That's correct.
And I think that can be incredibly powerful, especially when you're in those higher tax brackets. That income becomes even higher than what we might quote to you. We might say, okay, you're getting a 4% income, but depending on your tax bracket, your after tax, excuse me, how do I always get that? I always get that confused.
You're actually saving a lot more.
Yeah, you're
earning more. You're earning more because you're saving, right?
You're earning a lot more, right? And so that's important. There's a list of them, but you can also think of treasury bonds.
Mm-hmm.
We as financial advisors weren't talking about treasury bonds for years because there was no income. But now, after having all of these interest rate hikes over the last year and a half or so, treasury bonds are actually paying something very attractive. And, and there's a consideration on a state and local level of that income being tax-free as well. So I think that these are some important considerations for investors. And again, I think it's all about, you want to diversify, right? But
Yes.
You want to diversify your buckets, retirement accounts, some of these specialty accounts. You want to make sure that you have the most efficient investments in these different buckets. You want to be thoughtful about how you're looking at your tax return, whether you're itemizing it or standard, considering the credits. There are so many moving parts, but I think that in this day and age where we're all complaining about taxes doing nothing but going higher and higher, it would be very prudent to take ownership and make sure that you have an understanding, or that you're partnering with someone that has an understanding of making that more efficient over time.
Right. That's what I was going to recommend, is partnering with the right people to help you, because there's a lot, and it's even hard to remember all the rules, because they change so much.
Yeah, absolutely. And I think it's also important that if you're working with different professionals, maybe one's a financial advisor and one's an accountant. Julie, you and I've had this conversation all the time. I know our firms talk to each other. For clients that we do work with together, we're constantly calling accountants and asking about different ways to create opportunities going forward. I think that's an important dialogue that should be had.
Yes.
Yeah. Julie, I did neglect one, which I think is incredibly important, which is the tax loss harvesting. So before we end this conversation, let's talk a little bit about that one as well.
Yeah. So tax loss harvesting, as you well know, as a financial advisor, is a strategy where you sell certain investments at a loss to reduce your tax liability at the end of the year that you're going to owe. You can do this harvesting any time of the year, but typically when we work with our clients, we'll do a tax plan projection, and we'll work with the financial advisor. We'll get projected income, gains and losses for the year, and see if there's any losses that can be harvested, if there's going to be gains recognized. So that is a good tool to use for sure. And even though you might not be able to take all of the loss, you can take up to $3,000 in excess of any gains, and you can carry forward the balance unlimited. So there's no time period. So it really works well. I do want to say, watch out for the wash sale rule. And if you have a financial advisor, they'll do that for you, because there's a 30-day window, which I'm sure Jelena can talk more about, where you can't take a loss if you buy it back.
Exactly. And I think I realized that I skipped the tax loss harvesting when I talked about the importance of the accountants and the financial advisors talking, because that is a huge piece of our conversation with accountants, is calling and saying, do we have any losses from last year that we can utilize for this year? Right. Because you as the accountant are inevitably going to know that final number. And that's incredibly important. And I think it's also important a year like last year in 2022, when everything was down, right? Stocks were down, bonds were down, and there was a lot of frustration. That is a year where advisors, and for example, what we do at our firm, we were very busy trying to take some of these losses and take advantage of those so that we have them to utilize in future years. And sometimes it's hard for a client or an investor to see that opportunity. But the example that we would try to say is, we're going to sell out of this mutual fund, for example, that's down 10%, but we're going to keep you in the market, and we're going to go and buy this mutual fund that does something similar, you're still in the market, you'll receive the recovery, but we have now a loss that we can utilize in your portfolio to offset that future gain that you're going to eventually get.
Right.
Is
Right.
that a fair way to say it?
It's very, yes. Makes
But
sense.
to your point, you have to be careful about the investments that you're going back into and how you're going back into once you take that loss.
Right.
Yeah. So very important one. I am embarrassed that I left it out, but I'm glad we hit it before the end. So hopefully we weren't too detail oriented. And Julie, thank you for helping me walk through these, because it's always important to get the perspective from your end. And I don't know if there's anything that you want to add from, based on what we talked about and what your experience has been with clients with these conversations before we go.
Yeah, no, I think I've expanded on many conversations that I have had with clients. I mean, it is a year end, and actually even during the year, we're doing tax planning for clients who want it. So, and we're working with financial advisors. So it's a work in process all year. That way, you know how you're doing and there's no surprises.
Yes. And it's certainly not a set it and forget it situation.
No, that's not.
So, and Julie, if anyone does have any questions, if they want to reach out to you, what's the best way for them to do that?
Yeah, so you can go to our website, Simione, Macca, and Larrow.
You can spell that?
Yes, it's Simione, Macca, and Larrow, Larrow.
Okay, great.
And I'm also on LinkedIn, so you can find me there.
I really appreciate it. I know that, again, this is, not the most entertaining of topics, but I do believe it is one of the more important ones when it comes to our financial awareness. So
yes,
your insight is valuable. Thank you.
Thank you.